Aurodeep, good morning. Thank you so much for your time. The inflation reading, though on a bit unexpected lines, came in above the 5% mark, thanks to perhaps what's happening in the veggies side because of erratic monsoon. But do you expect it to remain sticky for some time? It appears even RBI is readying the street that inflation is sticky, rates could remain higher for longer.
There are three things really to watch out for as far as July is concerned. One is that we have this massive favorable base effect that kicks in. So last year, June was 4.9%. That spiked to 7.4% in July. So simultaneously, the July number coming up will be impacted by a favorable base. But that's going to mask a lot of the upside pressures that are there. One, as you mentioned, vegetable prices. These are typically the months when vegetable prices go up quite a lot. And in fact, the daily data that we are tracking is showing that vegetable prices is probably going to be as much, if not higher, than what we've observed in June. The other aspect is also that telecom tariffs were increased by around 20% or so in end of June. And so the impact of that is likely to be visible in the July the July print. I mean, the same thing happened, if you remember, in end 2021. Telecom companies raised their tariffs. The impact on telecom CPI was a little less than 5% month on month. So nevertheless, these factors are likely to play. Now, looking forward, yes, food inflation is going to be an upside risk. But on the positive side, we have El Nino turning to La Nina, which essentially means that we should be getting good rainfall this year, which should stem some of those risks. We have ample stocks of rice. We've had 2 years of high pulses inflation. Typically, pulses has a cobweb cycle, so you've got 2 years of high prices, and then overproduction leads to a glut in prices. So we expect pulses inflation to moderate in some time. So overall, on the food inflation side, we are cautiously optimistic. On the core inflation side, the underlying inflation remains quite low. It's in the 3.5% range. Both core goods and core services inflation sort of remains in a disinflationary zone. So we expect that softer consumption growth and just lower underlying pressures will possibly lead to core inflation remaining below 4% in throughout FY25. And for headline inflation, we expect it to remain around 4.5% or so.
Okay, fair enough. And I wanted to also get in your thoughts then on the overall theme of what the outlook is when it comes to infrastructure status, because given the kind of capex that the central government had doled out at about 3.5% versus 3.4% in the interim budget, what is it that you're expecting from the entire sector as a whole with a thrust on infrastructure?
As you've very rightly mentioned, the central government has been raising capex quite aggressively. In fact, a few years back, it was around 1.7% of GDP. It's literally doubled to around 3.4% of GDP. Our view is that in the final budget, they'll probably increase that from 3.4 to 3.5% of GDP. So I think capex is going to be an important part of not just the next budget, but also the government's vision over the next few years. I think the key challenge for India is a broad-based recovery on the private capex side. I think one of the alarming pieces of news that we've got over the past couple of weeks or so is the CMI data on new investments, which actually on a 4-quarter rolling basis has fallen to a little over 7% of GDP from around 10% of GDP in Q1. So this is Q2 calendar year versus Q1 calendar year. And so I think the bigger question is the broader recovery of private capex in India and the start of that capex cycle. But I think focus on public capex is going to be paramount in the coming years.
Okay, fair enough. And what is going to be your outlook when it comes to, the kind of expectations when it comes to the tax revenue growth projections? Is there anything that is expected in terms of a boost to the consumer demand by perhaps raising the standard deduction? Is that going to be an expectation?
Yeah, look, I mean, uh, our view is that there are going to be a few themes as far as the budget is concerned. First and foremost is, as you mentioned, on the consumption stimulus, be it in terms of increased amount which central government pays to farmers by around 2,000 rupees or so, or tax cuts, especially for the segment of the population that has the highest propensity to consume, could very well be there. The other aspect is just focus on social sectors. So be it on rural housing, rural employment, on expanded health insurance. The third aspect, I think, is going to be very important in terms of manufacturing, right? So the expansion of the PLI scheme to more labor intensive, more MSME linked sectors, on the tax rate on new manufacturing firms. And then, of course, as we discussed earlier, on infrastructure. And the fifth one, I think, is going to be very important in terms of just outlining the roadmap, the economic roadmap for the government in the next 5 years, and also the fiscal glide path, which currently the fiscal glide path ends in FY26 at 4.5% of GDP. What happens beyond that, I think, is a question that markets will be looking for in this budget. So yeah, I mean, the way I'm looking at this budget is that yes, fiscal deficit could actually go down. Our call is that they may announce 5% of GDP versus 5.1% of GDP in the interim budget. But that said, these are likely to be the focus areas.
The outlook when it comes to the rural sector schemes, do you think that there is going to be an increase in the overall outlay? Are there going to be, is a particular focus on rural schemes this time around? Is that the expectation?
Yeah, absolutely. I think be it in terms of rural employment, which is the MGNREGA, be it in terms of rural infrastructure, rural housing, and be it in terms of the expanding the women empowerment program, Lakpati Didi. I think these are going to be important milestones. The way we are looking at it is that on the Capex side, the outlay increases by around 300 billion rupees or so, which is close to 0.1% of GDP. For revenue expenditure side, where a lot of these rural and social sector schemes and support to states might reflect somewhat, we are expecting close to 700 billion rupees increase. So that's around 0.2% of GDP.
Right. Thank you so much, for joining in with us this morning on ET Now, talking to us about the budget as well. Aurodeep, it's a pleasure having you on this show.
If you like this video, then like, share and subscribe to ET Now.